In this video, we're going to dive a little bit deeper into the balance sheet. So, in the first learning objective, we're going to explain the uses, limitations, and content of the balance sheet. The balance sheet, sometimes called the Statement of Financial Position, reports assets, liabilities, and equity at a specific date, or actually not even as a specific date, as of a specific point in time, because even as of a date during the day, you can be spending and receiving money, making all sales. So normally the balance sheet is a snapshot of your financial position on the close of business on the day that the balance sheet is dated. It provides information about the company's resources, obligations to creditors, which are liabilities or debts, and equity in net resources. Net resources are the assets minus the liabilities. And the balance sheet can help in predicting the amounts, timing, and uncertainty of future cash flows, although the cash flow statement is a little bit better at that. Now let's take a look at the usefulness of the balance sheet. The balance sheet can be used to compute rates of return. They can also be used to compute turnover ratios, which we'll learn about later in the semester. They can use to evaluate capital structure. A company has a choice of financing through either debt or equity, and by looking at the balance sheet, you can evaluate those decisions. The balance sheet can assess risk and future cash flows. It's very good at analyzing the company's liquidity. That's how much cash and near cash it has versus how much money it owes currently. Solvency, how much money it owes compares to the total assets. And financial flexibility, how much more borrowing capacity the company has. There are some limitations of the balance sheet. Most assets and liabilities are reported at historical cost. So, for example, if a company purchased a plot of land in the middle of Manhattan in 1949 for $100,000, and a stack of real estate experts are swearing that the land is now worth $20 million, it is still recorded at $100,000 on the balance sheet. The balance sheet uses judgments and estimates. So, for example, we're going to estimate bad debt expense, estimate the useful life of our assets, and also estimate warranty expense. Also, many items of financial value are omitted. Companies can do off-balance sheet financing as well as do leasing, which would not occur on the balance sheet. Now let's take a look at the elements of the balance sheet. The elements of the balance sheet are assets. Assets are things of value that are owned or controlled by the corporation. Liabilities, you can read that definition of liabilities, but liabilities are simply debts. When a company has a liability, it owes somebody something. Now that something is usually money, but it also can be property or even services. We talked about that in Chapter 3 when we did adjusting entries. And finally, equity. They talk about equity as residual interest. Equity is simply in accounting assets minus liabilities. Why? Because if you own a business and you want to get out of the business, one of the ways you could do it is sell all the assets for cash and then use that cash to pay off the liabilities. Any extra would belong to you, the owner of the company, so that is why the best accounting definition of equity is assets minus liabilities. Now, assets have 5 different categories and liabilities have 2 different categories. So assets are divided into current assets, long-term investments, property, plant, and equipment, intangible assets, and other assets. On liabilities, it's a little bit easier. There are only 2 categories, current liabilities and long-term liabilities or long-term debt. And finally, on the right side of the balance sheet, we also state the owner's or the stockholder's equity. The first category in assets are current assets. Current assets are cash and other assets a company expects to convert into cash or consume in 1 year or less, or within the operating cycle, whichever is longer, but it's usually 1 year. So typical things that you will see included in current assets are cash and cash equivalents. Cash equivalents are things like savings accounts, which you can write a check against, money market accounts that you can write a check against, short-term investments. Short-term investments are stocks and bonds that are actively traded on the stock market that you can just call up the broker and sell and convert into cash in a number of days. Also, commercial paper. Accounts receivable is another current asset. You don't expect to collect your receivables in more than a year. Inventories are another thing you don't expect to hang around for more than a year. And prepaid expenses that expect to be consumed within 1 year. So cash and cash equivalents are shown at their fair value, their nominal value. Short-term investments are shown at generally the fair value, which is normally the market value. Receivables are shown at the full amount less the amount estimated to be uncollectible, so the amount shown for receivables is the amount that you actually expect to collect. Inventories are shown using LIFO, FIFO, average cost, but even then, if the inventory value has declined, you will even show it at a lower value in that case. And finally, prepaid expenses are shown at their amortized cost. So, talk about cash. Cash is generally any monies available to pay, either right now or within a few days. I told you cash equivalents are highly liquid investments. If there are any restrictions on cash or commitments that must be disclosed. So, for example, sometimes if you have a loan, a bank will require you to have a compensating balance. Let's say you have no less than $5,000 in your checking account. In that case, it would be restricted because you can't spend below that amount. So here is an example of how cash and restricted cash and investments would look on a balance sheet. Now we have restricted securities and other assets, restricted securities. Okay, now let's look at short-term investments. All equity securities are recorded at fair value, with changes reported in net income unless accounted for under the equity method. Generally, short-term investments would not be accounted for under the equity method. That's reserved for long-term investments, or if the market value is not readily available. Now let's look at short-term investments in debt securities. There are 3 separate classifications for debt securities: held to maturity, trading, and available for sale. We're not going to go into that right now because that is a future lesson, something to look forward to. Here is the balance sheet presentation of some of those short-term investments. This is what it would look like on a balance sheet. Now let's take a look at receivables. Receivables, the major categories of receivables, whether they're trade receivables or other receivables, should be shown in the balance sheet or the notes to the financial statements. A company should clearly identify the expected amount to be collected and any anticipated loss due to uncollectibles, the amount and nature of any non-trade receivables. So trade receivables arise from the selling of merchandise. Non-trade receivables result from other activities, maybe, let's say, renting out some space. And a company must disclose receivables used as collateral because then they're pledged against a loan. Here is the balance sheet presentation of accounts and notes receivable net, with the note of the disclosure of the major parts of the accounts and notes receivable. Now let's take a look at inventories. When you have inventories on the balance sheet, you must disclose the basis of valuation. lower of cost or net realizable value, or lower of cost or market, along with the cost flow assumption used, either FIFO, LIFO, or sometimes average cost, which again, that is coming up in your immediate future, so we'll learn more about cost flow assumptions very soon. Now, if you have several categories of inventory, so a manufacturer would have raw materials, work in process, and finished goods. All of those must be disclosed in notes to the financial statements or on the face of the financial statements themselves, which is a little less common. This is how Weyerhaeuser Company would show their current asset category with their inventories. So you can see all the different categories of inventories. Now, let's move on to prepaid expenses. Prepaid expenses are payment of cash that looks to be an expense, except we learned in Chapter 3 that an expense has to be all used up, no future benefit. So if I pay insurance for the current year on January 1st, technically I haven't yet been covered by that insurance, so there's no expense that exists yet. So what I actually have is an asset. I've purchased the right to be covered by insurance in the future. Supplies are another example of prepaid expenses. We pay for them now and use them in the future. Advertising could be a prepaid expense. We pay for it today, but run the advertising in the future. Rent can be a prepaid expense. Very many companies will pay rent months in advance to lock down those premises. And many companies pay estimated taxes, and some of those payments are prepayments. Now let's take a look at the balance sheet presentation of our prepaid expenses and other current assets. Now we're going into the next section. So we had just talked about current assets. Now we're going to talk about non-current assets. There are several categories of non-current assets: long-term investments, property, plant, and equipment, intangible assets, and other assets. So the first section, long-term investments, include things like securities, bonds, common stock, or long-term notes. But if they're included in long-term investments, they're not actively traded. So you plan on holding them for more than a year before you're going to be selling them. Tangible fixed assets. Tangible means that it has a physical presence. In a few minutes, I'll talk to you about intangible assets. But tangible assets that are not currently used in operations, so land held for speculation or a warehouse that you plan to use in the future. Special funds would be included in long-term investments. A sinking fund is where you make regular payments, where you know what you want it to be, what you want the total to be at the end. So let's say that you're saving up money to pay off a $10 million bond issue. What you're doing is you're creating a sinking fund, so at the time you make that last payment, you'll have the $10 million necessary to pay off the bond issue. Then we have pension funds, plant expansion funds, or cash surrender of life insurance, could all be special funds. And finally, in long-term investments, non-consolidated subsidiaries or affiliated companies. Non-consolidated subsidiaries are those companies where you own 20% to just under 50% of the stock of the other company. So when you have one corporation owning stock in another corporation, it is more than 19.99%, but less than 50% ownership. And affiliated companies are ones that work together, have another agreement, or own each other's shares of stock. Long-term investments is usually presented on the balance sheet right below current assets. The section can be called investments or long-term investments. Debt investments that are classified as available for sale are reported at fair value. Held-to-maturity investments are reported at amortized cost, and equity investments are reported at either fair value, which is the current market value, or by using the equity method. And don't worry, both of those, how to report it at fair value and how to use the equity method, are all in your future. So this is what our long-term investments would look like on a balance sheet. The next category on our balance sheet is property, plant, and equipment. Property, plant, and equipment are those tangible, long-lived assets that are used in the regular operations of the business. So if you have land that you're not using, that would not be in property, plant, and equipment. That would be in the investment section. So property, plant, and equipment includes physical property such as land, buildings, machinery, furniture, tools, vehicles, and wasting resources. Wasting resources are those that deplete over time. So for example, a forest or a gold mine. With the exception of land, a company will either depreciate or deplete all of the assets in property, plant, and equipment. So physical property will depreciate and wasting resources will deplete. In either case, you'll see either accumulated depreciation or accumulated depletion on either the balance sheet or contained in the notes to the financial statements. So this is what the property, plant, and equipment would look like on the balance sheet. This is the presentation where you show all of your property, plant, and equipment, subtract your accumulated depreciation to show the property, plant, and equipment net. The next section on the balance sheet after property, plant, and equipment is intangible assets. Intangible assets lack physical substance and are also at the same time not financial instruments. There are some intangibles that are of limited life and they are amortized. Indefinite life intangibles are tested for impairment but are not amortized. The key indefinite life intangible is goodwill. So types of intangible assets include copyright. A copyright is the exclusive right to an original composition. It could be a book, a movie, a play, a painting, a sculpture, a photograph, or many other types of original compositions can be copyrighted. A copyright generally lasts for the life of the author plus 70 years. A trademark is a word, a phrase, or a symbol which identifies the brand of or the company. A trademark lasts for 10 years but can be renewable. The next type of intangible asset is a patent. A patent is the exclusive right to an invention, formula, or improvement to a previous patent. A patent generally lasts for 20 years. There are special rules for drugs. Our last intangible asset is goodwill. Goodwill only occurs when a company purchases another company for more than the market value of its assets. It is not amortized for GAAP because goodwill is seem to have an unlimited life. Goodwill is generally amortized for 15 years for tax purposes. This is what the intangible asset section looks like on a balance sheet. This is an example of the intangible assets section of PepsiCo. Our last section in the assets section is other assets. Many different types of assets can be in the other assets category, but that is usually very small compared to the other categories of assets. Other assets can include long-term prepaid expenses, prepaid pension cost, non-current receivables, assets and special funds, deferred income taxes, property held for sale, or cash or securities that are restricted for some particular purpose. Now let's move on to the other side of the balance sheet, liabilities and equity. Luckily, that side is not nearly as complicated as the asset side. We only have two classifications for liabilities. Liabilities are either classified as current or long-term. Current liabilities are those obligations a company reasonably expects to pay, either through the use of current assets, so for example cash, or the creation of other current liabilities. Generally, current liabilities need to be paid within 1 year or 1 operating cycle, whichever is longer. Types of current liabilities: they could be payables resulting from the acquisition of goods and services, so accounts payable, wages payable, taxes payable, and so on. Another possible account in current liabilities are collections received in advance, such as unearned rent revenue, unearned subscriptions revenue, or even tokens at an arcade. Other liabilities, such as the portion of long-term debt to be paid in the current period, or short-term obligations arising from the purchase of equipment. This is what the current assets section looks like for Halliburton Company. Long-term liabilities are obligations that a company does not reasonably expect to liquidate, which means to pay, within the normal operating cycle. So that would be 1 year or longer. Companies classify long-term maturities that mature within the current operating cycle as current liabilities if payment of the obligation requires the use of current assets. So, for example, I have a 25-year mortgage, so that might seem like it's a long-term liability, but I have principal payments that I have to make within the next year. So the principal payments that I have to make within the next year are considered current liabilities, and those payments that I have to make years 2 through 25 are considered long-term liabilities. So there are 3 types of long-term liabilities. Those are obligations arising from specific financing situations, such as the issuance of bonds, long-term lease obligations, and long-term notes payable. Another type is obligations arising from pension obligations and deferred income taxes. And the third one, obligations that depend upon the occurrence or non-occurrence of one or more future events, such as service or product warranties and other contingencies. Group 3 is called contingent liabilities. This is the balance sheet presentation of the long-term debt. Now we're into the final section of the balance sheet, owner's equity. If you have a sole proprietorship, there is only going to be one equity account, owner's name, capital. If you have a partnership, each partner has one equity account, owner's name, capital. But if you have a corporation, it is required that the corporation keep separate earned capital and invested capital. So the first 2 accounts that we see here, capital stock and additional paid-in capital, those 2 together represent the total money that investors have invested in the corporation by buying common stock. We'll learn more about those 2 accounts in Intermediate 2. Then there's retained earnings. Retained earnings is just the sum from the time the corporation is incorporated of all of the net income minus all of the dividends. And finally, there are some items, for example, gains and losses on available for sale securities that don't go directly into retained earnings, that go into other comprehensive income, that you will also see in the owner's equity section. That is basically another retained earnings for things that don't come from the normal operation of business. Then we're going to see treasury stock. Treasury stock is generally the cost of shares that are repurchased by the corporation. Treasury stock is considered canceled. While the treasury stock is held by the corporation, they do not earn dividends and they are not part of any liquidation. And finally, the last bit that you'll see in the owner's equity section is the non-controlling interest. So if you own 90% of another corporation, you're required to consolidate. You don't bring in 90% of the assets and the liabilities, you bring in 100%, even though you only own 90%. So what happens is you show this extra equity account that represents the non-controlling interest, the part of that consolidated company that you do not own. This is the balance sheet presentation for Las Vegas Sands Corporation equity section. Finally, the last thing that we're going to do is prepare the classified balance sheet. There are two ways to show a classified balance sheet: account form and report form. Account form is where the assets are on the left-hand side and the liabilities and equity are on the right-hand side. Report form has the assets listed first and then the liabilities and equity listed below that. So Accounting Trends and Techniques indicates that all of the 500 companies surveyed use either the report form or the account form, sometimes collectively referred to as the customary form. So this is what a report form looks like. So you can see on the assets section, first come our current assets, then our long-term investments, then comes our property, plant, and equipment. After property, plant, and equipment comes intangible assets, and this company has no other assets, so we see that our total assets is the sum of the subtotals for current assets, long-term investments, property, plant, and equipment, and intangible assets. On the liability and equity side, we have our current liabilities, our long-term debt, and our stockholders' equity section. And notice that total liabilities and stockholders' equity balance total assets.